Everybody, and thanks for being here. So, the topic that I have to talk about and where we have to talk about today is what do VCs think in the context of the climate opportunity. And we have on the stage two VCs to know what they think, but we also have an entrepreneur to know what they really think. So that's, I think, a great combination I have here. I think the first question I would start by asking the VCs, and Shailesh set the context right in the beginning when he said that for a long time climate was part of impact investing, and impact investing and for-profit investing were for some time considered different, and he thought that was the approach that could not be taken. But I want to know from the VCs, both of you, Kunal and Ashish, what is your thought on how easy or difficult is it to judge the two on the same yardsticks? If you may, like.
Yeah, I think as a community and as the ecosystem, I think the VCs, a lot of financial investors deliberately stayed away from, in general, climate for a long period of time. So climate, of course, this has become a big buzzword at this point of time, but the word has been around for quite some time, right? So only when people figured out technology matured, there were policies in place, and smart capital started moving into this area, that people thought that this is the time that we could make that investment. And from what I know, most people, Tejinder, the way they have structured the entire investment into climate and the other investments have been by having separate teams, right? So some funds have actually gone and said that, hey, we will go and raise a specific climate fund, which is what I think Shailesh and Nipan was talking about early in the, But at the same time, there have been funds who are saying that, hey, climate will be a part of it. And honestly, climate so far in India at least has been a lot more on the EV and on the solar side, not really so much on the other aspect. It is still in the making, right? So I would say that having separate teams, some of the funds have also introduced different IC, investment committee member, to evaluate certain, the climate, and, which may require a little more expertise there. Those are the things that, so I don't think it is very different actually from that perspective, whether you're looking at, let's say, a consumer tech or a SaaS company or a B2B. This is what most funds actually do it in India. So if similarly new dimensions have been added on the climate, and there has been skilling, there has been skill development required, but that's exactly what we as investors try to do, right? I don't think we as investors are expert in anything, and all that we try to get to, honestly, is try to get to 70-80% of what we can know of, and that can be serviced by building some expert network, some ICT members, and separate teams.
Yeah, no, absolutely. To add to what Ashish said, I think climate is a big, broad brush. You have to look at opportunities within that area where there are definitely, pain problems that technology can solve for and can be solved for profitably, and you can make revenue. I think there are enough problems and challenges that we are facing as a country and its people, that there are billion-dollar opportunities across the entire space. Now, as a fund, we of course focus a lot on the mobility or the electric or EV side, but within that also there are pockets of opportunities which effectively are businesses you can solve for just using software, not necessarily large capital requirements or infrastructure. I think the only capital allocator that doesn't bother about IRR, financial return, is the government of India. And there are certain projects will always be funded by taxpayers' money, and that's fine by us. But as a fund, I think it's important for us to recognize the fact that we have a fiduciary responsibility towards our LPs or investors. So if I cannot make investments in companies that ultimately will generate profit and return, I think we will be out of business pretty fast. So it's our job to identify opportunities where you have the operating or the leverage, the operating leverage that comes from use of technology. Ultimately, you can solve for a lot of problems here, where you have a good financial outcome, and ultimately you have a number of benefits, social benefits, whether it's employment generation, reduction in pollution and things like that. So there is absolutely no need to say that you can't achieve both at the same time.
So Arjun, you have been, same question to you, but from the other side, as a entrepreneur focused on climate tech, what has been your experience vis-a-vis maybe other peers who are like a little more standard company, maybe consumer tech or SaaS? So what is your experience of the challenges raising funds as an entrepreneur and the reading into the minds of the VCs?
Sure, thanks. So first I'd like to explain our business just in 1 minute. It's a combination of technology and infrastructure. So we work on cooling and automation. There was a talk about cooling being a very large end use, and it's very true. It's going to be 800 gigawatts of new power demand in India in the next 25 years. So that's like all of the renewables that we're building are going to go to new cooling demand. So, our business combines an element of technology with an element of infrastructure. So we started about 7 years ago, and for first 4 years we didn't look for funding. We looked to create a profitable business, which we were able to do. Then, the reason was we didn't feel that in the initial 4 years that there would be really rapid growth. And what we realized is that investors like to fund and back rapid growth, right? And most people are not looking to make a 10-year bet. They're looking for a 4-year or a 5-year bet. So initial years, establish the business profitability that we did through grants and also through debt capital and some of our own family and friends' money. Then when we thought, okay, we are ready to scale faster, we went into the market to raise funds. And our experience there was that, like the gentleman said and the speakers before, capital light models are very much liked, capital heavy models are not very much liked by VCs. But VCs are not the only form of capital that is available. There are longer term horizon partners and investors available. So in our first round that we raised from a bunch of different types of companies. One was an Indian corporate, a very large corporate that wanted to invest in our company. Because of COVID, that deal broke down at the last moment. Then we got a bunch of HNIs and 2 climate funds, climate-focused funds that came in to invest in the company about 2 years ago. So now we are in the next phase of growth of the company, which is the next round of funding. And again, we have some interesting perspectives to share. We've spoken to, I think, about 60 to 70 different investors, some serious discussions, some casual. And what I learned from that is that there is a lot of interest in different areas of climate. I think earlier it was a little focused on 1 or 2 areas. Now there's a more diverse focus. Second is that the early checks are easier to come by. I think there's a lot of money in the first check that is available. I think there's still a gap in the second and the third stage of funding. Really longer term capital with an understanding of infrastructure. I think there's a little bit of a gap there, but I think over the next 2-3 years that will also get filled.
Okay. Thanks, Arjun. So, and it's an interesting point you leave at in terms of the early stage checks being more easily available while the later stage checks are tougher. And here I think I'll come to Ashish. Ashish, you are a B plus stage investor, late stage investor, and in the context of asset light versus asset heavy, where asset light series B might be much smaller, but an asset heavy, actually the numbers can become pretty big. So what's your thought on how, because a lot of climate investing could be a lot more money required. So how do you see that, especially in late stage? How will you be able to invest at all and write those bigger checks?
Yeah, so in general, for venture capital asset class, any business which is asset heavy, right, and requires equity capital to build that asset, is usually not a good fit, right? And that is true for any type of businesses. India, I think, has behaved slightly different as compared to the Western market. So we do see little more affinity towards assets because that's where India is, and I'll give you some examples of that. So in India, even on the consumer side, the businesses which have done well, they are usually a lot more full stack than pure play marketplaces, which is the case in, let's say, US or more developed markets, right? So there is a little bit of that understanding that in India, when you have to go for higher value proposition in the hands of the customer, you need to build some asset. Now, the ratio between, so that's one example. The second example is also, let's say, lending companies, right? Lending companies in India does require some asset because, you will require some equity and then you will raise some debt as a leverage, and then you kind of build that business. So there is this inherent understanding, and these businesses have made money in India. So I don't think Indian investors are as averse to investing in little more asset heavy businesses as compared to what we have seen, let's say, in the Western markets. Now, at least when I have looked at businesses in India, whether it is climate and maybe I could talk a little bit more about climate, and my learning and understanding is a lot more influenced by EV and solar rather than anything else. So this may not necessarily be relevant to everything else. Is that if your business requires asset, I don't think that is a challenge. But if you are only going to fund that asset through equity, there's a challenge. You'll have to take either some leverage, and I think there are smart investors who have done that. I think Puneet from Blue Smart, which actually did talk about, said that in total he has some $300 million, out of which half of this was equity and half of that was debt, right? So while I don't know the ratio, what all that has happened, but I think that's one example of it. The second example of what I have seen is that, which is even more smarter, right, is India, see, we are almost, from an entrepreneurial perspective, we are a 4,000-year-old, economy country, right? So, in our country, even 4,000 years back, there used to be entrepreneurs. So we are a very entrepreneurial country. So when you look at today, and I'm noticing that a lot of the venture-backed companies, while they raise capital equity, they don't necessarily use, and even if their business requires asset, they have gone ahead and partnered with the smaller mom-and-pop entrepreneurs to put some of those capital in asset and do some kind of franchisee model, some kind of, some kind of business partnership, right? And my sense is that a lot of those things will start happening. So the smart entrepreneur, my belief is that will figure these things out. I don't think we can brush the industry by saying that, hey, this is an asset heavy and so people won't invest. I think there has to be an entrepreneur who has to stand up, raise their hand and say that I understand this is what it requires, this is what the value proposition is, that is what I have to solve for. But the business model need not be same as what it has done so in let's say a developed market. So, if you look at the first set of climate tech investment in the US, right, and a lot of these blue chip VC funds actually invested in those companies did not make any money. And there's one argument from our investors, the investors of the venture fund, that hey, you guys should not be doing it, or you guys should be careful of doing it. And I think the answer to that is that India is very different and all the stuff that I talked about. So I do think India will be in a better position to be investing in climate tech companies.
Just to add to that, I think ultimately, yes, there are businesses that can be pure SaaS businesses within climate which don't require a lot of assets. So those are great opportunities to do. And if there are certain businesses that require physical assets and infrastructure, and actually you can create an asset-light business to solve that problem by itself. So we are actually working with companies that are creating marketplace models that are mapping those that need debt with those that are there to provide the debt. So you've created an asset-light business which is solved for that itself. That's an opportunity in itself. So it's not really black and white. I think that there are businesses that will need capital, there are businesses which will not, or you can create an asset-light model to build and profit from companies or opportunities which require a certain amount of debt itself. So it's all about understanding the lay of the land, understanding where the large opportunities exist, then investing. Given the fact that it depends on which stage of the investment cycle you want to enter into, you raise the point that raising early rounds of capital seems to be easier than raising large, because it's easy to start a $10 million fund and much more difficult to start a $300 million fund. So you will have a lot of people fighting for funding good founders that are in the early stages of development, which is one of the reasons why we are a sector-focused fund, so that we stand out from the crowd rather than being sector agnostic. And that's why we've been very fortunate to partner with a number of founders, and we've created 8 category leaders in our space, all in the mobility space. So there are opportunities in asset-heavy businesses itself, which are actually asset-light.
Okay, so basically what I hear is that you can have different models, a combination of models, debt coming as part, And then I think you made a great point, Ashish, about the franchisee model where you can get, and that maybe actually, you're very right, is maybe a little more specific to India with its culture of micro-entrepreneurship. I think that's a great point.
I'll just build on that. Actually, in our business as well, we've been able to, I think we've used more debt than equity capital to be able to fund the projects and the capex that is required in the business, and also been able to use retail investors, like individuals like you and me. They want to invest in an asset and they want a long-term stable return, right? When you're not able to get debt, there are individual investors that will invest as well. So I think there are a lot of different types of capital available, and that's something that all entrepreneurs should keep in mind. What's the right color of money for the right use?
Thank you. See, when I think climate, actually, there's one aspect of climate that comes to mind, which is core technology change. Because I feel there are a lot of climate-related problems which will not happen just by changing the operating model. Like, for example, we saw in a lot of consumer tech and all, it was a little of an operational play or a technology-enabled play. But I feel climate will require, I don't know, carbon capture, for example, might be a totally new kind of technologies, water filtration. And so how do you see venture capital backing technology development or the core tech businesses where the technology is still being developed or experimented with? What is your view on how will that get funded by venture capital? How will they evaluate, especially when in the last, I would say 5-7 years, VCs have been seeing a lot of traction and a lot of wealth has been created purely by doing these operationally different things. So how do you see core tech getting funded?
Actually, what you mentioned is very, very important. And that's, I think, the core competency of a VC itself is to be able to deploy capital in very high risk and high return opportunities where the probability of success is low, but if it succeeds, then the outcome is extremely high. So I think, and that's really the area that where you do distinguish a VC from other forms of capital, is that the VC model is actually structured in such a way that we are okay with 50-60% of our investments not making it, as long as the ones that do, they do. So new technologies, innovation, etc., which you said are going to be extremely important and critical to solve the large problems and issues that are facing the country with respect to climate across the different areas is I think that's an area which we as VC specialize in, because we have to have the ability to help founders go from -1 to 0 or 0 to 1. That is sort of the, in an evolution, in new technology and new businesses that are evolving, that's an area that we specialize in, whereas later stage capital is very good where you have product market fit, where you have certain acceptance of what you've built to grow from 1 to 10 or 10 to 100.
I have a slightly different point of view as, against what Kunal said. I do think that any company which is not near commercialization, any technology will find it difficult to, get institutional capital, right? Kunal is one of the braver ones, I guess, right? But I have not seen that happening. So I think climate change angels, right? That may be a little bit, they will have a role to play, right? Because you don't really have to kind of answer any institution there, right? So that is something I do think about it. Fortunately, unfortunately, at least what we do is that we come in at a Series B, so at least we don't have to deal with this problem, right? So we are very happy looking at having Kunal take that risk and figuring out that initial journey. And once we think that, hey, they are in the space where the business model is getting clearer, technology is there. So we will take some technology risk, may not be in the base case of the business, because typically what has also happened in the world now, right? So earlier, 15 years back, the world was a lot more simpler. People used to have one product market fit and they would scale that company for the next 10, 15, 20 years, right? I think given how rapidly the world is changing, it almost feels like every 3 4 5 years, there is a new, product market fit that happens, or there's a new go-to-market fitment happens depending on what kind of business are we talking about, right? So there is always those risks that somebody has to take, but yeah, that's what I would think about.
Okay, so Arjun, I'm sure you have been in that situation, and maybe some of your peers, other entrepreneurs you meet who are doing core tech development in that area. What is your thought?
I've seen two very different ecosystems. One is out here in India and one is in the US, in Silicon Valley, as well as in the East Coast. Very, very different ecosystems. What I feel is that what we need to do more of is co-creation, real co-creation. So if I see the VCs that are really successful there, who have invested in most of the good companies that are coming out in climate tech right now, they spend a lot of time on campus. They teach classes, they are in touch with professors, they know who are the people who are working on technologies, and they get in very, very early in co-creating a thought process and a game plan on how a technology could be commercialized. Now, if you look at a typical tech person in a PhD or a master's or even a bachelor's, tech person, they don't necessarily know how to create a business. They can't even think 10 years out how it could pan out. So, you know, and that has repercussions in how they're thinking about their business today. So I think a lot more co-creation and collaboration needs to happen at the early stages of innovation, which I feel is a little bit missing over here. I have seen it in pockets, but I think a lot more of that needs to happen if we want real technology innovation to come to bear. Because our typical geeks, they are not thinking about 15 years and creating a big business. They're thinking only about technology. And it does require that marriage and that conversation to happen early on to envision how an idea can be scaled up.
I think that's a great point, and sort of like an immediate corollary for me of that is this whole collaboration between educational institutions and academia with VC. So I guess that's one of the ways you think co-creation could work?
Absolutely. I think the lady from the UN was mentioning practical education as well, right? I think that has a huge role to play. And VCs have a role to play there, like go to campuses, teach courses on how to create a business, right? I benefited from that. I started a company while I was a student, and you know that company is still running about 15 years later. And that started from a class on campus. So I think, and there's hundreds of examples like this that I know. So I think a lot more of that needs to happen. And again, I like to think of things as positive. There is a lot of movement in that direction, at least, that has started.
Great. I think, thank you so much. So changing track a little bit, Arjun, a question to you. Now, we've seen the heydays of venture capital and then huge returns and then a funding winter happening. So what do you see things changing for climate? So do you think the funding winter has been a little different for climate focused ventures vis-a-vis edtech, consumer tech, etc.? What has been your experience? Are you seeing that things are bad for you or worse for you? Are you feeling you are now at least not as bad as the other people? What's your view?
Well, I think a lot of people have money to invest. So the winter for climate companies, I would say overall is not as bad because funds have money. 2-3 years ago, funds didn't have that much money. Now at least funds have money to deploy. Now, are they deploying that money today as aggressively at the kinds of valuations that people want? No. So I think, you know, a little less of an impact. I think the investment from FOMO is probably gone. Right? There were a lot of investments just done out of FOMO. You find a good entrepreneur, like, okay, I want to be a climate investor. I think that sort of has gone down a little bit. People are looking more rationally at a business to look at, you know, how it can grow and on the fundamentals of the business. In these days, I think investors are definitely looking, are more aggressive on the valuation, pushing back on the valuation to entrepreneurs. And so that's my reading of the market. We are fundraising and we have been, and I know a bunch of other people who are doing it. So I think that's what it is. Money is available. The FOMO is gone. And I think now the investors at least are thinking they're in a better position to get better deals. And you know, that's just the wave that happens.
Kunal, Ashish, what is your view on how the current stage of the market conditions have made your job different and your perspective any different for climate?
No, I think this is the new normal, and if you ask me, I think for an early stage seed fund like us, this is actually a better time to deploy capital than it was earlier. So we were predominantly a mobility focused fund, so honestly our funding winter was COVID. I mean, that was pretty much a time where majority of my portfolio companies who had zero revenue and high costs, and we were all getting into survival. So this is what's happening now is actually probably a walk in the park compared to what happened 3 years ago. Fortunately, I think where we are today is that there is, of course, enough dry powder available in the market. Good founders building good companies with sensible unit economics will always raise capital. I think if you think about it, how do you define the right valuation? I think that's pretty much a difficult question to answer. If your company is not successful, the valuation is irrelevant. If the company is extremely successful, that 10-15% delta in valuation is irrelevant. So we as a fund are pretty pragmatic about that. We will fund good founders. For us, the quality of the founders is more important than the percentage of stake that we have. And that's been sort of our mantra throughout. So I think the funding winter, yes, is definitely there, but it's all relative, right? If you had a pendulum swing 2 years ago, 1.5 years ago, where there was a lot of irrational exuberance, that's not normal. So this is really not a funding winter. I think it's more a funding spring. And it's a good thing because we need reality, both from the founder's perspective as well as the investor's perspective. So if you ask me, this is probably the best time to deploy capital from pre-COVID days.
I think more than the funding winter, I'm actually worried about the strong AC here. It almost feels like shivering here, like that feels like winter. So I actually agree with what Kunal said, right? That I don't think the funding winter from a venture capital perspective is actually a good news, right? It may not be that good a news for, let's say, somebody creating the company or, let's say, crossover funds, right? But for venture asset class, I think it's a good news. Specifically on climate, I was actually chatting with somebody who has a fund manager who has been raising capital this time, right? And he actually told me something pretty interesting. He said that Ashish, last year, which is when we raised our previous fund, all the people were talking different things, but this year everyone has been talking about ESG as the theme, right? So everyone has been raising on, climate is a big buzzword and so on and so forth, right? So at least to all the founders, I think there is absolutely a lot more money marked for climate-related investment. That is because that's what the story has been told and sold and so on and so forth, right? So valuation, I actually agree. Even though we come in at a mid stage where we are a little more sensitive to the valuations, but if you're talking about a company which could potentially be worth a few billion, honestly, 10-20% does not make a difference. I think the challenge, at least in 2021, was that it was not 20%. In some of the cases, it was also 10 to 20 times, right? So I think then there was a little bit of a challenge, and but I think we as an industry, as an ecosystem, are just evolving, growing, and I kind of almost look at this as that we were in the teens, and there is a problem associated with anybody there's a plus and there's a minus of being in teens, and that is what we were going through. I think a lot of this, at least in the industry that we understand, right, which is the internet industry, which is where most of the big companies have been created so far. I think it is the new normal. Climate is the big word. I would, if I were to really guess, I would think that when the market comes back up, climate will be the new buzzword, and there people will be a lot less sensitive about the valuations again. People will continue to be sensitive on the internet industry, may not be as sensitive in the climate. That's what at least my experience has been looking at market cycles.
I think that, thank you so much. I think this was really wonderful. So